Thanks for clicking. Federal Reserve Chairman Jerome Powell wants to keep interest rates high and end the Fed put. That is, the assumption that the Federal Reserve is going to come to the rescue of the market. This according to my interview with Danielle DiMartino Booth.
He is on a mission to kill the Fed put.
Booth is CEO at QI Research, served at the Dallas Federal Reserve for 9 years, is a regular contributor to Bloomberg and Fox Business, and is the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. I had the good fortune to speak with Ms. Booth the day following Fed Chairman Powell's interview with 60 Minutes, during which she painted the picture of a Fed chairman intent on remaining tight, not giving the markets what they want, 0% interest rates, and attempting to impose discipline on an ever-burgeoning U.S. debt, all of which will have a big impact on us here in Canada. We will continue to track developments coming out of the United States and how they impact us here in Canada on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. All right, so today I'm joined by Danielle DiMartino Booth, CEO of QI Research, who also worked at the Fed for 9 years and is the author of Fed Up. Ms. Booth, I just want to thank you so much for being on the show today.
It's great to be here. Thank you for having me.
Definitely. So I do want to get right into the jobs report that came out on Friday. Yields are up almost 40 basis points. Does this mean that the Fed pivot is going to happen, or are we in for higher for longer?
I think that even though once you peel back even just one layer of that jobs report, that you know that there's little justification for the Fed to not go ahead and start cutting rates. I think it was much more so Jerome Powell's appearance on 60 Minutes on Sunday night that really did hammer home the fact that he is going to continue to rely on and to cite headline data, even if that headline data is the equivalent, something just north of garbage. Again, he is on a mission to kill the Fed put. Very few in the market want to believe him, but he has gone on for almost 2 years now. He got reconfirmed by the Senate in May of 2022. So he's been on this mission for almost 2 years now, trying to break the Fed put. And that means that even when he knew the JOLTS data, the job openings data, that it wasn't really all that it was cooked up to be, all that it was advertised, he still cited it. And I think that we'll see the same out of him when it comes to, headline payrolls coming in at 325,000 in January. Oh my gosh. And then you peel the onion back and you find out that since the month of February, not a single full-time job in the United States has been created. But again, he doesn't care. He needs a shield behind which to operate to try and break this Fed put, which means really holding the feet of those who depend on a huge pivot, holding their feet to the fire, making things like private equity firms mark to market for the first time in generations.
So he wants to keep rates high. He's just looking for data to justify it.
That is, yes, you said that in a much more succinct way than I did. Not a lot of people understand that, if you're a public pension plan and you have a huge multi-billion-dollar in allocation to private equity, that you really haven't gotten a clean valuation on those type of alternative holdings for multiple decades, because the Fed has always ridden to the rescue and made sure that they were able to provide a valuation by virtue of the fact that interest rates, oh, look, they've gone back down to zero again. So there's always an easy way to fudge valuations in that environment. But there has not been zero interest rate for a very long time.
And I think I heard you say last week that the Fed wants to keep rates high to a certain extent to discipline the federal government, to discipline the fiscal side of the equation. Do you think that's going into his thinking as well? Like with the amount of money that the U.S. is borrowing this year, do you think that's at the top of his mind as well?
It is, when 60 Minutes, Scott Pelley asked him that question, on 60 Minutes, he was very diplomatic and careful in how he answered that question. But by the same token, he did allude to the power of having for so long had reserve currency status and what that affords the United States and the risk that would be posed to the country if it was not for the tremendous amount of power that the United States wields. He didn't mention the dollar in particular. That would have been a huge no-no. But he did indeed speak to protecting, to making sacrosanct how powerful a nation we are because of what we get to exert outside of our borders and how important it was to protect that. His role, the role that he plays in protecting that, is making sure that the United States government reins in its inability to really to stop spending like drunken sailors, to cease and desist wartime fiscal deficit spending at a time of peace.
Right. And we haven't seen that in a long time coming out of a Fed chairman concern about the fiscal side, or even I was surprised to even really see him go as far as he did during that interview.
I wasn't surprised because it's pretty clear that Congress has not gotten the message. And in fact, Treasury Secretary Janet Yellen has gone the other way. She's actually proactively fighting the Fed by flooding the market with Treasury bills to try and minimize the country's interest expense, not borrowing out longer, which would more quickly deplete reserves from the system, and making sure that Treasury auctions run smoothly by flooding the system with Treasury bills. So this was definitely on Powell's part an implicit message to say I see exactly what you're doing, and I'm on to you.
So on that note, I'm glad you brought up the Treasury auctions, as we've talked about it quite a bit on this channel, that the auctions haven't been going as well as the U.S. hopes that they would. And when that happens, we see yield spike here in Canada. Obviously, Treasury yield spike in Canada follows. But there's record levels of debt set to hit the market this year, with 7.6 trillion renewing plus deficit financing. And it's not clear the market is going to be able to handle that. In your opinion, what's the Fed do if we keep seeing these failed auctions? Is it NQT?
Well, first of all, we're not seeing failed auctions.
Sorry, I shouldn't have said failed. You're right.
What we saw last year was a very tenuous 30-year auction. There were a lot of different things going on at the time, and then the subsequent long maturity treasury auctions went just fine, surprising most market participants and further fueling the rally. Of course, we've got the 10-year yield right now at about 4.16. That's down appreciably from that momentary flirtation that it had with 5%. And the market has indeed been able to absorb the issuance by the Treasury. The most recent announcement, it ensures market players that she's going to continue to lean on Treasury bills as hard as she can. That is not what I would call disciplined behavior on the part of the Treasury Department, but that's neither here nor there. It's an election year. So she's going to try and do whatever she possibly can to mitigate any interest expense spikes that can be cited in TV commercials for the opponents. And it really does come down to that. It comes down to the fact that we're in February, and that November the 5th is not a far long of a ways off. And she's going to try and do everything she can. I think Powell's appearance on 60 Minutes was meant to say, in this election year, I'm not going to help you. I'm not, and because I think he made it clear that he sees the Fed playing an assisting role as being in violation of its duty to be apolitical and nonpartisan, to say nothing of trying to appear to help one individual or another be victorious on election day. I think he was saying loud and clear, it's not going to be my position. I don't think March is on the table. I'm going to push that off as far as I can. I think a lot of Fed officials have said that they don't want to even talk about, they don't want to even ponder shrinking the balance sheet until the second half of the year. Discussions as to when and how and by what extent they're going to taper the shrinkage of the balance sheet. We know that's going to occur in March. He said that at the podium, but again, all they're going to do is talk about it. And he really is trying to slow walk easing in any way, which of course infuriates everybody who says he's pivoted. He's fallen like a deck of cards. It really is aggravating to those particular market players who have been operating under the assumption that he was going to be an easy Fed chair when he's been anything but.
He's kept it a lot tighter, a lot longer than I think a lot of people anticipated. What do you make of when he came out in December and then we got and said 3, the market took it to mean 6 cuts, and we had the pivot party. He had to have known that was going to happen. He must choose his words very carefully, I would assume. And so he came out and said that we were getting 3 cuts. The market got over its skis, as it were, and then he had to walk it back. Do you have any thoughts on why he did that?
I mean, I think that I think that a lawyer from Chevy Chase is probably not. He's not a thespian, so he hasn't been to acting school. He knew that he needed to communicate the message that there were not going to be any more rate hikes in December. He wanted to communicate that message before the Iowa caucuses and to get out in front of that January the 15th event, knowing that the Fed was not going to meet again until January, or at least meet January 30th, announce January 31st. But he did a great job subsequent to the market's overreaction of walking back those expectations. But it's, if you're sitting there staring in the mirror and saying, how do I communicate a pivot, but not too aggressively? How do I do this and have the market not celebrate twice as much as what I'm communicating? Because they've only been disappointed 6 other times thinking that it was a pivot that I was communicating and then it wasn't. So how on the 7th time am I perfectly nuanced, not too hot, not too cold? And I think the way he figured out how to be is as in the middle as he intended to be and communicate there would only be 3 rate cuts in 2024 was to walk it back after the fact.
That's a good point. And I think this came out in the 60 Minutes interview. He's definitely in a rock and a hard place right now with this upcoming election. I know here in Canada, a lot of commentators say, well, he's going to lower rates because the election's coming, but he's kind of taking great strains to say, no, he's not. But it looks like no matter what he does, like if he was going to cut rates in June or July anyway, it's going to be perceived that it's political, regardless of whether or not the economy necessitates it.
Well, I don't necessarily agree with that. I think that he can be as communicative as he wants, and he can say that there is a long tradition of the Fed not raising or lowering interest rates in the meeting that immediately precedes the election. That would be the September the 18th meeting. That's the last meeting before the election. Of course, they meet on November 6th and 7th. Highly unusual that they're meeting on a Wednesday and Thursday, but they're specifically avoiding meeting on election day. So they've moved that meeting out. That's very intriguing. But he could easily say that we're going to go May, June, and July and stop.
Right.
And reassess. And however he wants to communicate it, he can do so because he's communicated all kinds of things that market participants have not wanted to hear over the years. He's managed to use the power of the pulpit very, very shrewdly. And I take my hat off to him for that, as well as having market participants know that when certain other officials who are very close to him speak, that they're effectively speaking on behalf of Powell.
So he's used the bully pulpit much better than his predecessors.
Oh, I think that is the case. Right. And much more importantly, he has proven that he is going to refuse to stand down to the will of the markets. Whereas Alan Greenspan, October the 19th, 1987, that was when he started standing down, all of 2 months into office. Bernanke was even more afraid of his shadow, and Yellen was just petrified. So by now, any of his 3 predecessors would have taken the Fed funds back down to 0 by now. but he's not them, and he has not done so.
And I've heard you say before, don't expect us to go back to zero either.
I think that it's perfectly feasible that we return to zero, but not while Powell's chair.
Okay.
And I think I think that he has seen, and that we've all witnessed, that the zero bound is it's not all it's cracked up to be. It encourages mass speculation, and that if it can be avoided, it should be avoided. So and you see Jay Powell's dot plots end as far out as the eye can see in terms of the Fed projecting the future path of interest rates. As far as the eye can see, there's a 2 handle in front of that number. So you don't even see projections that it's going to go below 2%. And I think he believes, and I would concur, that 2% is plenty low.
Definitely low by historical standards. We're really not that high going back decades or even centuries.
That's right.
5% is really not that high at all, even though it seems to be based off the last 20 years.
Well, and it certainly feels much higher because there were so many entities and or households who have fixed rate mortgages for 30 years at 2.75%. You know, a doubling of that level is going to feel very high, no matter what, because of what the base is. And we're definitely seeing that with some of this meltdown in commercial real estate. There's simply too big of a divide in between where a given building was originally underwritten and the equity that would have to be provided, cash, in order to refinance at the level that might be, again, double what they originally were paying, and that's simply too much cash to cough up, especially in a section like offices that have obviously been permanently impaired.
So I'm glad you brought up the effect that higher interest rates are having on the economy, and that you spoke about earlier that a lot of the majority, if not all of the 350,000 jobs are part-time. Do you see a real economic contraction coming out of the U.S. in 2024?
I do. There are only 2 markers that are visible right now that reflect a robust economy, and that would really be just headline non-farm payrolls and initial weekly jobless claims. We passed the highest level in the latest week. We actually went above 2019 levels for continuing jobless claims. So they're just about 2 million at this point and rising, and they've been stubbornly high. Throughout the entire year 2023, we saw retail sales adjusted downwards upon revision, and we have seen a string of revisions when it comes to the non-farm payrolls. We would have a 4% unemployment rate right now had we not seen desertions from the labor force, people giving up on looking for work in December and January. So really right now, literally the only thing telling us that there's strength in the economy is headline payroll formation and initial weekly jobless claims. Dig into that 325,000 jobs that were created. There were 6 times more than the norm in professional and business services job creation in the month of December, in a month in which we saw north of 103,000 in layoffs announced. And so you see these types of anomalies and you ask yourself, is it that the government statisticians' models are off, or that people who are laying people off are lying to us? Well, which is it?
Yeah, because there does appear to be a big disconnect. We see every day thousands laid off, and then we see these numbers come out, and I think it's surprising everyone because they're not adding up.
You wake up on any given morning, Monday, you say, gee, I'm going to be talking to this great guy in a blue golf shirt in Canada any minute now. Oh, look, Estee Lauder's laying off 3,000 people. I mean, it's one after another, and it's not necessarily isolated to Silicon Valley or to Wall Street. It's a more widespread layoff cycle that we're in, and it's the third wave of it, which people tend to forget. People tend to forget that in November of 2022, Amazon announced its first 10,000 layoffs in its technology division and headquarters.
So things are worse under the hood than they look
They are,
going into the
and
year.
people absolutely do not want to hear that message because it is so much. It's so much easier to just listen to what the labor secretary is saying on the White House lawn, rather than stop and say, "Wait a minute, that doesn't seem right. Why am I seeing all these headlines?" And then you hear this that the job market's doing great. Something doesn't connect here.
People in the markets want to hear soft landing and back to zero.
Yeah, they want soft landing. They want back to zero, by the way, for no reason, not because the economy needs it.
Yeah.
And they want to hear quantitative easing is going to begin again.
And do you think it will eventually?
Again, not under Powell.
Not under Powell. Okay. So
And
depending
I,
on
I think, look, if there's a credit event,
right.
we knew that Japanese banks were up to their eyeballs in collateralized loan obligations in late 2018. Powell had to pivot. He had no choice. You can't, on your watch, be a central banker that says, oh, look, there's systemic risk. I'm just going to let that go and see what happens. And if it takes down the global financial system, so be it. You can't be that way as a central banker. If there's a credit event, then he'll have to stand down. He will not have a choice. And I was personally surprised last week to see a very large Japanese bank come out and announce commercial real estate losses attached to US properties. I was equally surprised after Lehman fell to learn that German Landesbanks had concentrated holdings of US subprime mortgages back in 2008. You never know where the surprise is going to come from in a mammoth global financial system, but Jay Powell does not have, Jay Powell's duty bound to not allow systemic risk to come unglued, and that's just a fact of life. If that's not the case, QE, I do not think will come back, nor will central bank digital currency or universal basic income or modern monetary theory or the zero bound. All of those things, Jay Powell has said, need to go where they are in the dustbin of failed experiments.
So if QE comes back, it's not for a good reason. We won't be celebrating.
Oh,
right.
No, QE will come back in the context of a brutal recession.
Right. Not something to look forward to. Okay.
No.
Okay.
We're all better off. Look, it was all sunshine, roses, bumblebees, and rainbows on 60 Minutes. And it was his duty to say that commercial real estate's not going to be a great, big, bad thing because it's not in the biggest banks. Well, you know what? It's not in the biggest banks, but it's in the banks that are right underneath those banks. But again, it's his job to not go on national television on Sunday evening and say, hello, America, the economy is going to fall apart. He can't say that. He's not allowed to yell fire in a crowded theater as chair of the Fed. He has to be a statesman. But unless something systemic breaks, I think he's just going to continue allowing the controlled demolition. We've seen just before recording, I saw 2 bankruptcy Chapter 11 filings where each of the companies had more than $100 million in liabilities. The controlled demolition that started with the first rate hike continues.
I agree with you that he's not going to come out and say that something bad's about to occur. If a comma moves in a Fed speech, the Dow moves by 500 points. So he does have to be very careful. So you think he's just going to watch this play out, and if there's no accidents, he's going to go along as he would anyways.
I think so, but again, it is very difficult to press forward with the regulations that he's contemplating that would rein in the non-banking sector that really has just been able to run roughshod over many of the financial markets, lever up treasuries to the hilt, play 24/7 with the basis trade. But he is trying to bide his time and press forward with tighter regulations that really would make the financial system much stronger than it is. But in order to succeed, he has to continue pressing forward and hiding behind data that he knows to be specious. He has to do that.
I think I like that perspective because we don't hear that too often that he actually wants to see this data and that there's a bigger, I don't want to say agenda, but a bigger focus at work here.
There is, but
Yeah.
comment periods to press forward with something of the magnitude of Basel III endgame. He knows that that will not come to fruition until 2026, and that he literally needs to buy time.
Right. Well, you've given the audience a lot to think about today. That's I really appreciate you being on taking the time to be on the show, especially with so much going on. So again, I want to thank you, Ms. Booth, so much for being on the show, and yeah, thank you.
Well, thank you for having me. And I'd love for anybody watching to come over to dmartinobooth.substack.com. And I'm sure you follow me on Twitter, but if you don't, then please do so at DiMartino Booth.
All the links will be in the description. Thank you so
Fabulous.
much.